Hey guys, what's up? Alec back with the daily stock market, and we have a banger video today. We're going to talk about one of the most popular topics that everyone wants me to speak about all the time, and that's stocks that are under $10 per share. So we're going to be talking about Robinhood, Carnival Cruise Line, XPEV, and if we have enough time, we're even going to jump into DraftKings, Palantir, SoFi, and Ford. We haven't talked about these stocks in a long time. So if we don't get through all these stocks, make sure you're subscribed with post notifications on, because we're definitely going to do a part 2. And make sure you comment below what stocks you want to see under $10 in part 2. Other than that, just subscribe with post notifications on YouTube for the full length videos, and let's jump right into the video. And the first one up is Robinhood. We haven't talked about them in a while at $10 per share, up 28% in the last 3 months. They were at $8 per share earlier, okay? And we've seen them as low as $6.80 earlier this year in June. If we scroll down, you can see that my average cost is $9 per share. I want to get that under $8. I think Robinhood could potentially even go down to $7 per share once again. Now that might be kind of hard because they have a lot of cash on their balance sheet and their market cap is $9.3 billion. Okay, keep in mind they also have a 52-week high of $43 per share. They're down nearly 75% from highs. And if they get back to $40 per share, that's a 400% return on your money. So they're definitely worth at least looking into to see if the risk versus reward is worth it. Here we have the risks, an article with an analyst saying with crypto down, this will be a tough buy with Robinhood. Okay, and with the stock market down and less people trading stocks, it's also the same story. Robinhood has significant exposure to the crypto market, and with the crypto market trending lower, this poses a significant risk to Robinhood's near-term growth rates. Robinhood has seen its share price rapidly increase since the summer lows, as investors believe that now is a good time to buy the dip, and we saw that it was up around 25 to 30% in the last couple of weeks to few months. However, I remain bearish on the name overall. I don't believe that investors will be rewarded from paying 6 times this year's revenue for Robinhood. Indeed, I focus my bearish thesis not on its upcoming Q3 results, but on its Q4 period. Now, if we look at a total revenue graph from 2019 when it IPO to 2021, we can see that it has been growing steadily and increasingly. But if we look at the quarter over quarter revenue growth, we can see that it has been trending lower, and it fell nearly 40% from 2021 Q2 to 2022 Q1. Okay, so that's a little bit alarming. We can also see that, yeah, they do have 24 billion in assets, but they also have 17 billion in liabilities, which is another alarming thing. Okay, if we look at their cash and cash equivalents, they do have 5.9 billion in cash and cash equivalents. And their liabilities are 17 billion. So that is a good thing to see that they have that much cash, almost 6 billion in cash. And remember, their market cap right now is only 9 billion right now. So that's why a lot of people are saying that Robinhood's a good deal, because the market cap, what it's worth in the stock market, is almost the same price as its cash reserves. But one thing to pay attention to is watching that cash and cash equivalents and making sure that it's not shriveling up. And a way we can do that is we can scroll back, and if we look at the cash and cash equivalents, we can actually see that it was higher. It was at 6.1 billion, 6.25, and now it's trending down. So we definitely don't want that cash and cash equivalents to fall under 5 billion or even 4 billion. That would be a huge red flag for Robinhood. And we also want to see the improving towards a profitable on their net income, because right now we can see that they're negative 3.6 billion on their net income, and on per quarter it's about negative 300 million that they're losing every single quarter. So that's a huge thing, a huge red flag. And that's why their share price is down so much in the first place, is because they just can't make it to profitability, which investors really want to see by now. Okay, so the next one up is CCL at $7 per share, down 30% just in the last 30 days, which is actually a very interesting time to be talking about CCL because they just made it newer, lower lows. As you can see, even when the pandemic was in full swing and the end of the world was happening in 2020, we did not see Carnival stock as low as it is today. And we did see Carnival stock rebound 150% to 250% just in the span of about 1 year. Okay, about 12 months of holding from April 3rd, 2020 to June 4th, 2021. We saw Carnival stock do absolutely absurd growth to $30 per share. So the question is, can Carnival stock go from $7 per share to $30 per share once again? And the answer is absolutely yes. This could also be one of those stocks that is one of those meme stocks that goes viral, and we're catching this meme stock before it's a phenomenon. Okay, we can see Carnival go back to $70 per share if that's the case. Something like AMC takes over. The fundamentals we'll jump into in a second. However, I don't believe that this is a fundamental play. This is probably more of a meme stock play, a risky swing trade, and at $7 per share, I'm willing to tag along. I'm probably going to be putting at least $200 to $500 in Carnival stock to hold for the next 6 to 12 months, around $7 per share. And if it drops as low as $6 or $5 per share, I'll even buy more. Okay, I'm looking for Carnival stock to go back to $20 per share, $25 per share, and even hit $30 per share once again, which I definitely think it could happen. It looks like around summertime is when a lot of people were probably booking cruises. So that was a little bit more popular time. So when summer and spring roll around, I think Carnival stock can shoot up. So that 6-month swing trade looking pretty good on Carnival stock right now. Even if I can get 100% gain on Carnival up to $14 per share, I'll be happy and take probably a lot of profits even at that level as well. Also on the fundamental side, one thing to note is that they don't only own Carnival, they also own Holland America, Princess Cruise Line, and I was actually looking into Princess Cruise Line and Holland America, but specifically Princess Cruise Line, if you go on the website and look at some of like their European cruises, for example, they're already booked out, they're sold out fully years in advance. Like the summer cruises, like May, June, Italy cruises, Greece cruises, they're already selling out. So the demand for cruises is coming back. They also dropped all their vaccine mandates and mask mandates too. So people aren't worried about vaccinations anymore and COVID. So that stuff's going away and the demand for cruises is actually picking back up. And if we go to their total revenue, we can see that the numbers are backing that up. Look at this absurd growth that it's been having quarter over quarter. This is not year over year. This is quarter over quarter growth. Okay, from 2021 Q3 at 500 million in the quarter to 1.2 billion to 1.6 billion to 2.4 billion in 2022 Q2, and now we see 4.3 billion in total revenue, okay? Just in the span of 4 to 5 quarters, that growth has accrued to 4.3 billion. So as we can see, the demand is obviously catching up now. The stock price hasn't reflected the absolutely absurd revenue growth that we've seen Carnival bouncing back from. But look at the risk on this balance sheet, okay? I feel like Carnival is on its last leg. I hate to say that, but in reality, I feel like cruises aren't going to be going anywhere. You know, Carnival and Royal pretty much dominate the seas when it comes to cruising. There's going to always be a demand for cruising too. The demand's picking back up. So I'm not too worried about the balance sheet just because they have such a competitive edge. Unless something like Royal Caribbean just takes over, for example. But a good thing you can do on your spare time is pull up Royal Caribbean's balance sheet and see if it's much worse or much better than Carnival's balance sheet. But the total revenue is an interesting thing. Remember, this is more of a risky play anyway, a meme stock trade and a high risk trade at a low stock price, only $7 per share, with goals of around $15 to $25 per share to sell at for CCL. Now, we did just do a full electric vehicle deep dive into Rivian, Lucid, and Neo. So if you need an update on any of those electric vehicle stocks, make sure you check out the last video that was uploaded on the YouTube channel. We're going to go over XPEV real quick because they're under $10 per share. They're at $9.25. We can see they're down 10% in the past week, down 40% in the last 30 days. So there could be a buying opportunity here. And they're also down 67% in the past 3 months. And obviously the stock has been absolutely obliterated from all-time highs, down 85% with an all-time high of $64 per share and an IPO price of $23 per share in August 2020. We can also see that they're about half the size of Neo when it comes to the market cap. And we can also see that some of the bulls say younger generation car buyers value vehicle tech experience, giving XPEV leadership over legacy car makers. Advancing battery technology and charging solutions will ease range anxiety on electric cars. Chinese consumers' soaring demand for electric cars will benefit car makers such as XPEV and Neo. Total revenue, by the way, is $7.4 billion. So they're doing way more total revenue than something like Rivian or Lucid, which is very impressive because they're a third or a fourth of the price of Rivian and Lucid. Okay. And their net income obviously isn't good. That's why their stock price isn't doing so hot. You know, they're losing $2.7 billion a year. However, their balance sheet is looking beautiful. Okay, 70 billion in assets and only 29 billion in liabilities. So they could afford to burn a couple billion for at least 1 to 2 more years before they hit profitability. Okay, they have a lot of cash and cash equivalents. They have 29 billion in cash and cash equivalents, and this company right now is only worth 9 billion in the stock market. So if anyone knows anything about fundamental investing, explain to me how that does make sense if they have 29 billion in cash and cash equivalents, but their market cap is only 9 billion. Okay, so it's just something to think about. Long-term investing, this is obviously a long-term investment, but it's a long-term investment that could pay off and could be a 3 to 5x return on your investment over the long term. But you want to dive deep into something like XPEV and be like, why am I going to invest in XPEV over something like Neo? Or why am I going to invest in XPEV over something like Tesla? Okay, so those are the kind of questions you got to ask yourself if you're considering putting hundreds or thousands, especially if you're considering putting thousands or tens of thousands of dollars into a stock like XPEV. Definitely be asking yourself those questions. Okay, so here we see an analyst article talking about 70% down since June as fears about a slump in deliveries and widening net losses have manifested. However, these fears seem overblown as Forex impacts were the only driving factor to widening losses, and deliveries seem poised to rebound with more models on the way. While capacity can support up to 400,000 vehicles next year at max, forecasting 18,000 vehicles per month volume paves the way for 60% annual growth, which is what any investor wants to hear. And if you look at something like Lucid, by the way, I think they only have like 6,000 deliveries for the whole year, where something like XPEV is doing 18,000 per month, and they're at about a fourth of the valuation or a third of the valuation of something like Lucid. Okay, so XPEV could, and remember there's a lot of fears with China happening right now too, so that plays into why XPEV is trading at such a discount right now. XPeng is potentially targeting over 120,000 G9 units along with 2 to 4 new vehicles in 2023, supporting a rapid recovery and growth in deliveries, valuing XPEV at 1.4 times their EV to revenue for 2023 projects an 110% upside on the share's price. Okay, so if you want to scroll through this article and pause it and read and look at some of these graphs yourself, feel absolutely free to do that. So comment below if you want part 2 of this video, because we still have to talk about some of those other stocks under $10 per share like DraftKings, Palantir, SoFi, and Ford. Make sure you share this video with a friend if you think that they can find some value in it. Hit success number 6 on the highlight section of my Instagram and follow me on Instagram if you're not following there yet. But go ahead and read some of these success stories into my private group where I post all my trades, all my buys, my sells, when I'm buying, when I'm selling, what contracts, expiration dates, and it's for beginner traders who never traded ever before. I lay it out super easy lingo to understand, not all this advanced lingo that nobody can understand. So it's for beginners, it's developed for beginners, it takes you through the right path, and I also have more advanced programs for more advanced traders too. So reach out to me on Instagram. I message every single person back. Thank you for all the love and support you've been showing on my Instagram and the YouTube channel as well. Subscribe on YouTube with post notifications on. And remember, if you're already subscribed, make sure you hit that post notification bell so you're alerted anytime these new videos come out. And I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.